Picture this. You wake up Thursday morning, check your phone, and Bitcoin has dropped 15% overnight. Your portfolio is bleeding red. Twitter is screaming, "Crypto winter." Your hands are shaking. You're about to hit that sell button. And right then, you see it. The crypto fear and greed index just hit 9 out of 100, the lowest reading since the FTX collapse, since Sam Bankman-Fried was arrested in his Bahamas penthouse. So here's the million-dollar question. When everyone is panicking, should you panic too? Or is this the opportunity you've been waiting for? Today, we're breaking down exactly what's happening psychologically right now, why fear cascades like this, and how to flip it into your edge. Stick around. This could save your account. Let's start with what just happened with Bitcoin. Between February 4th and 6th, 2026, Bitcoin had its worst two-day performance in over 3 years. We're talking about Bitcoin crashed from $75,640 to below $60,000. That's a $15,000 drop in 48 hours. The entire crypto market shed $2 trillion in value. Liquidations hit multi-month highs. And that fear gauge? It plummeted from 42 to 9. The last time we saw this level was June 2022, when FTX was collapsing and people thought crypto was dead. Before that, the 2019 bear market, when Bitcoin was at $3,000. Here's the thing. Bitcoin hit an all-time high of $126,210 back in October 2025. Since then, we've dropped about 50%. So what causes this kind of panic? It's not just the price dropping, it's the psychology. When Bitcoin falls this fast, volatility spikes, leveraged traders get liquidated, Google searches for sell Bitcoin explode, social media sentiment turns toxic, and momentum traders head for the exits. It's a classic fear cascade. And here's the thing about fear, it's contagious. Let's get into the trading psychology here, because this is what separates winners from losers in this game. When you see your portfolio down 20%, your brain doesn't think rationally. Your amygdala, the fear center, lights up like a Christmas tree, and it starts screaming, "Danger, sell now, protect yourself." This is called loss aversion. Psychologically, losses hurt about twice as much as gains feel good. So a 20% drop doesn't just feel bad, it feels catastrophic. And here's where it gets worse. You're not alone. Millions of traders are feeling the exact same thing. You check Twitter and you see, Bitcoin going to $40,000. Crypto winter is here. Get out while you can. This triggers herding behavior. You think, if everyone is selling, they must know something I don't. So you sell too. And when you sell, someone else sees more red candles and they panic. It's a domino effect. But here's what the data actually shows. Every single time, and I mean every time, the fear and greed index has hit single digits. It's been followed by a major bottom and recovery. Extreme fear usually doesn't mean sell. It means the worst of the panic is almost over. Warren Buffett has that famous quote, "Be fearful when others are greedy, and greedy when others are fearful." Easy to say, hard to do. Because when you're staring at red numbers, your brain doesn't want to hear about Warren Buffett. It wants to survive. Which brings us to the most important part of this video. You need to understand that you are fighting millions of years of evolution. Your brain has an ancient alarm system called the amygdala. Its job is to keep you alive when a saber-toothed tiger jumps out of a bush. It floods your body with cortisol and adrenaline. It shuts down your prefrontal cortex, the part of your brain responsible for logic, math, and long-term planning. Here is the problem. Your amygdala cannot tell the difference between a tiger trying to eat you and a red candle on a Bitcoin chart. To your biology, a 20% portfolio drop feels like a threat to your survival. This triggers loss aversion. Psychologically, the pain of losing $1,000 is twice as intense as the joy of gaining $1,000. So right now, you aren't making a financial decision. You are making a survival decision. You are panicked, so you look to the herd for safety. You check Twitter or Reddit and everyone is yelling, "Crypto winter." Your brain says, everyone is running for the exit. I should too. But in trading, the herd is the liquidity. When you sell during extreme fear, you are usually selling to an institution that has a plan. They are buying your fear. Let me tell you about a trader. We'll call him David. During a previous dip, his account dropped from $12,000 to $8,000. He panicked and sold everything to protect what was left. 3 days later, Bitcoin bottomed and rallied 40%. David sat in cash the whole time, then bought back in higher than where he sold. He didn't lose money because of the market. He lost it because he let his amygdala drive the bus. So how do we override this biology? It depends entirely on who you are. I want you to pick a lane right now. Lane 1, the short-term trader. If you're trading daily volatility, you need to stop thinking about doom and start thinking about probability. When markets get this oversold, when sentiment hits these extremes, mean reversion becomes statistically likely. That's not a prediction, it's just how markets work. Your job isn't to predict the bottom. Your job is to recognize when the setup aligns with your strategy and wait for confirmation. The opportunity is there, but only if you can remove emotion from the equation. Lane 2, the long-term investor. If your time horizon is years, not days, this is where you need to separate fundamentals from sentiment. The fundamentals, adoption, institutional flows, supply dynamics, those haven't changed. What changed is how people feel about it. If you believe in the long-term thesis and you have capital on the sidelines, moments of extreme fear are historically when long-term investors build positions. Not all at once. That's just another form of emotional decision-making. Dollar cost averaging exists specifically to remove emotion from the timing equation. The goal isn't to nail the exact bottom. The goal is to accumulate at prices that make sense for your time frame without letting panic or FOMO drive your decisions. Now, before I let you go, here's the reality check. None of this advice matters if you're already overweight in crypto. If you can't handle another 20% drop without losing sleep, you're not in a position to buy or hold. You need to use the next bounce to trim your position back to a level where you can actually think clearly. But here's the bigger picture. The fear and greed index hitting single digits is rare. It's terrifying, honestly. But history shows us something fascinating. The moments that feel the most like the end are usually the beginning. The traders who make it in this game aren't the ones who predicted the crash. They're the ones who could control their own psychology when it happened. So here's what I want you to do. Drop a comment below with a number from 1 to 10. How panicked are you feeling right now? Put it in writing. Screenshot it if you want. Because 6 months from now, I want you to come back to this video and see how your emotions lied to you. And if you enjoyed this video, be sure to check out my video on developing trader patience. I call it the crocodile principle. Thank you for watching. I will see you in the next video.